Most investors chase headline returns. This fund gave 12% returns, that gave 14%. But what really matters is what you keep in your pockets after costs, taxes, and whether the fund actually fits your goals. That's where structure, taxation, and planning come together. I'm Hriday Javla, brand ambassador of Discvr.ai, and today let's connect these dots. Because how you invest is often more important than what you invest in. When you choose a fund, the structure itself shapes your outcome. A direct mutual fund plan, for example, quietly saves you about half to 1% every year in distributor commissions. That may sound small, but over 15 years it compounds into lakhs. ETFs look even leaner, low cost, transparent, and passive. But because they trade like stocks, you pay brokerage and sometimes lose a little bit on the bid. ETFs look even leaner, low cost, transparent, and passive. But because they trade like stocks, you pay brokerage and sometimes lose a little bit on the bid and ask spread. And then there are funds of funds, which promise diversification but charge you twice. Once at the FOF level and again inside the underlying scheme. So before you look at your returns, you need to ask, what's the drag from cost and structure? And once you have cleared the cost hurdle, the next silent drag is taxation. This is where two investors in the same fund can end up with different results. For equities, if you sell before a year, your gains are taxed at 15% short-term capital gains. Hold longer than a year and you get the long-term rate of 10%, but only after 1 lakh of gains is exempt. Dev funds used to have a big advantage through indexation, adjusting purchase cost for inflation, often cutting tax bills to single digits. But since April 2023, that benefit is gone for new investments. Now, any gain in a dev fund is taxed at your slab rate, whether you hold it for 1 year or 10. If you're in the 30% bracket, that's a huge change. This is why the concept of tax alpha, how much returns you keep after tax, matters as much as the fund's reported return. Now, some dev funds try to manage risk through roll down strategies. Imagine buying a 5-year bond portfolio that gradually rolls down. 5 years, then 4, then 3 until maturity. If you stay invested till the end, your return path is smoother and less exposed to the sudden interest rate spikes. It works beautifully if your goals timeline matches the roll down. But if you exit early or if large investors redeem, the manager may be forced to sell bonds before maturity, which can reduce the predictability. And this is where fund structure and taxation naturally lead us to bigger picture. Planning around your goals, because at the end of the day, it's not just about the product, it's about the purpose. For example, take retirement, education, housing. Each goal demands a different mix. A retirement portfolio 30 years away can absorb equity volatility, but money for your child's college in 3 years should stay in the safer debt or roll down funds. Now, some investors use a barbell strategy, combining very conservative instruments with very aggressive ones, skipping the middle. The safe side ensures stability, while the risky side captures growth. Together, they strike a balance between safety and upside. Glide path matters the most. In the 30s, you may be 80% equity, but by your 60s, you glide down towards 30% equity. This gradual shift makes sure when you need your money the most, you're not hit by market shock. Now I know that's a lot of moving parts, structure, tax rules, debt strategies, life goals. And that's why I use Discvr.ai for managing my investments. With a few simple prompts, you can instantly discover the best mutual funds aligned to your goals. You can import your portfolios from Zerodha, Upstox, mutual fund, even debt holdings, and see your total net worth in one place. The platform gives you a health checkup, flagging risks, overlaps, and whether your investments really match your goals. And yes, Discvr.ai also makes learning with fun daily and weekly contests, where you can win up to 50,000 rupees in cash prizes. Well, it's not just about tracking, it's about making smarter and more goal-focused decisions. So remember, headline returns are only the surface. It's the structure, taxation, and alignment with your goals that define your real wealth journey. If you found this video helpful, hit the subscribe button right now, because the next part of this series will take you even deeper into the practical investing strategies. And don't forget to check out Discvr.ai. It could completely change how you see your portfolio.